Afternoon, everyone. On our panel today, we'll be exploring the use of distributed ledger technology, so DLT, and AI in the DCM and fixed income markets. So to start us off, we're going to be looking at, well, what are the motivations in terms of the use of DLT in the DCM markets? And to start us off, Yana will talk us through, well, as an issuer, her perspective, particularly in the public sector.
Thank you. So just the words on what ESM is, European Stability Mechanism. You can see us as sort of European IMF. We provide financial assistance to the 21 euro area countries in case of need, and we raise the funds for this financial assistance on the debt capital markets. So when technology can improve significantly the efficiency and the integration of the capital markets, for us this is very important both as a large supranational issuer, but equally also in a broader European perspective to support European competitiveness and to achieve the capital markets union. DLT in particular has the potential for the development of fully tokenized bond markets. And this is very important because with this, we can fully eliminate the settlement risk when we have this atomic delivery versus payment settlement. A lot of the previous panels highlighted other benefits of DLT, like speed, lower cost, transparency. But I would like to add also the opportunity to have programmable payments so that the whole life cycle management of bonds could become much more efficient.
Thank you, Yana. Thorben, what's your perspective on this?
Actually, good afternoon, everyone. Actually, I agree to all of that. I would just like to add from our experience, we conducted more than 40 transactions now, more than €1 billion. So we've got, I think, quite a broad picture of all the motivations. I agree to all these points. It's just that one has to also take into account that there are two different time dimensions, I would call it, implementing this technology. And then you've got the instruments, the transactions, the products, where you have an immediate impact. That is reducing settlement risk, for example. We have that in registered bonds. We drove down the settlement time from 7 days to 7 seconds. So that's obviously a clear advantage. And then you've got the more structural, architectural innovation that is happening. And there it is harder to convince the front offices that this is a good to use technology, because there is no immediate benefit in terms of P&L, but there's more structural benefit, obviously. And also, like in every innovation process, the new product that challenges the traditional technology is always meeting something that has been optimized for decades sometimes and starts pretty raw and underdeveloped. So to grasp the whole potential, you have to get around all the limitations and to have to keep on doing that. And it's difficult then to catch up if you're too late in the game. That's why we try to be very early a part of it.
Thank you, Thorben. So we've explored the DLT side of things. So when we look at AI in the DCM markets and what trends we're seeing, perhaps Danilo, you can start us off there.
Yeah. I don't think I can say anything to you guys you don't already know. I think the world of AI in the DCM markets, it's about compression. It's about doing things faster, doing the documentary, the preparedness part faster, more accurately. There's no difference there. Banking has been on transformation programs for 20 years or more, 30 years even. But it is different in the sense of today, I think with the capabilities of AI, you can create new experiences. And something that the way I love to explain it is, when you used to receive an email from a mass marketing tool and it has your name on it, 20 years ago, that was pretty cool. You almost felt like they knew you. But today, with AI, you have hyper-personalization, right? I've worked with a couple of banks when they release a new loan product. Instead of just having an advert for every country, we could then do an advert for every type of client in every country. So if there was a client that's been banking with you for 20 years and you have so much data on them, you know that as a boy, that client had already an account with you, as on the consumer side, was receiving money from their uncle, What we did is for one of the big clients, we created a commercial just for that client. So it's them going up to their uncle, talking, working with their uncle, and then one day taking a loan from the bank and driving up to Porsche, because we know that client has bought a lot of Porsches in the past, and then driving through that Porsche in Tuscany. And then guess what? That client also got the loan product that was launched as well. So I think hyper-personalization in experiences, how you keep providing services that provide value with AI, I think that's going to be one of the things that really differentiates the real players from the ones which are just copying everybody. And I think that's what's going to really set us apart in winning clients when intelligence becomes highly commoditized.
Thank you, Danilo. And Sorcha, what are your thoughts, particularly on the fixed income secondary market side of things?
Sure. I think the way that our AI experts are looking at AI is this opportunity to make our smart people even smarter and an effective organization even more effective. And the real distinguishing variable that provides that ability is the data that we can extract. Tradeweb benefits from its broad network, and the data and insights that we get and provide to our clients in the secondary market trading capacity combined with these AI tools provides like a really interesting convergence that we see that we'll be able to give a lot of interesting use cases for the clients. There's one tool that we have launched recently, which is our first AI research agent or chatbot integrating into this RFQ trading workflow. And so that's able to give real market insights to clients when they're making those decisions about the executions and the trades that they're looking to make. So it gives them dynamic pricing and liquidity information. And so it's about using these powerful new tools in a way that is truly tangible and useful for clients in their existing trading activities. And being a technology company, of course, the technology is really the most powerful and most important piece, and Danilo has shared so many interesting insights on that front. But also from our perspective, what's really valuable too is the client experience and the client contribution. And so we're really listening closely to that and making sure that there's appropriate market context as we integrate AI into the solutions that we roll out.
Thank you, Sorcha. Yana, so from your perspective as a supranational and your funding operations, what are you seeing?
So the way we decided to approach a really more advanced use of AI, particularly in our funding operations, was to team up with the University of Luxembourg. So they have world-class research capabilities, and we want to combine them with our first-hand market experience and knowledge. And we're really exploring AI use in 3 dimensions. First, we want to use AI insights for specific steps in our bond issuance transactions, like deciding when to go to the market, or which is the most suitable bank to support us on the transaction, or how to allocate our book of orders among the investors. The second work stream is about market intelligence. I know that a lot of organizations are working on it. What we're doing differently is that we are developing our own ontology for bond issuance, and we want to combine our own specific ontology with large language models. And the third work stream is really an ambitious one, or at least this is what the professor who is supervising it told me. It's trying to understand what is causing market movements. So we want to move from correlation to causality, and we want to combine our own quantitative analytical methods with AI. So these are the 3 dimensions, and I would like to use this opportunity also to thank the 20 banks who have really kindly agreed to share their data for the training of our AI models. That's really important, this kind of partnership. And also, we are very happy that the outcome of this endeavor, it can benefit the wider financial community, because all the research papers will be published, and potentially a broader range of institutions can benefit from that.
Thank you, Yana. And Fahreen, from your perspective, particularly from controls and surveillance, what are your thoughts?
Yeah, so with Behavox, I think there's 3 things that I would highlight specifically, which is we're in a very regulated market, and so because of that, I think it's not really how are you using AI anymore, it's are you using it, but can you defend it? And so from a regulatory perspective, it's is it defensible, and can you provide evidence for that? So the first part is really, are we able to actually not be a black box, defend every action, so when we stand in front of regulators or our board or clients, we're able to open it up and explain the decisions that have been made. Across the board, AI is being used. It's more, can you justify it? The second bit is, can we consolidate? So right now in capital markets, we are seeing multiple tools, and those tools are from the conduct side, from the compliance side, from archiving. How do you actually consolidate those tools and have a unified tech stack? And what does that ecosystem look like? Whereas the data is very important, but can that data speak to each other versus being in silos? That's where you're going to get the most actionable insights, but also where you're actually going to make decisions that are not just now tick box exercises, but they're actually benefiting the firm, either from a revenue perspective or from alpha generation. So we see that kind of as the second step, which is consolidate your tech stacks, look at the ecosystem of products you have, bring everything into one silo versus multiple, and then make decisions on the back of that. And then the last of that would be, how are you actually monitoring more than what you need to monitor? Because that's going to give you the actionable, intelligent insights. So it's not just, am I monitoring my emails and my Bloombergs and my Slack, but it's also, what about those unauthorized channels, but also channels that are not just your day-to-day emails and chats, but what about printer logs and keycard swipes and all of the data that actually already sits in your platforms, but you're not looking at to make a consolidated picture. So looking at that one holistic picture versus, again, I'm just going to look at the specific channels that need to be monitored versus how do I look at everything in a firm and then make decisions on that.
Thank you, Fahreen. And Thorben, if you can finish us off with your thoughts from a DCM support services perspective.
Sure. Yeah, in the markets division, we've got 3 live cases of AI that we have adopted. One is about research, one is about structuring unstructured trade data. And the last thing that I would like to talk about a little bit is hedging and risk position management. We've got, in the primary markets, we've got a focused operation on structured retail products. And for that, you need primary market risk managers, traders, who make up their minds of how much of the product is going to be sold and hence how much needs to be hedged. And now you have different categories of participants, obviously. The sales guys are always really upbeat and think, okay, this time we're going to sell a lot of that. And then you've got the traders who are more conservative and rather think, well, probably it's not going to work so nicely this time. So everyone has a bias. And we implemented an AI that took away the bias, actually. And now we have less variance in this. So every trader on the primary book now gets a recommendation of how much he or she should hedge based on the market parameters, on the structure, on the supply and demand situation. And actually, it is quite good. You're not obliged to use it, but it's a recommendation. The next step further is that for the flow business, we want to implement this AI, further development of that, in order to manage all the flow business, pricing, hedging, based on the risk positioning of the book, and so on and so forth. The tests that we are running there, so that the first one is live. The tests that we are running on this development are pretty positive, actually. And what we can say is that the AI is really much more neutral than any trader or salesperson that we currently have.
Thank you, Thorben. So coming back to DLT, we spoke earlier about the motivations and the advantages that DLT brings to issuances in the DCM market, as well as kind of the support functions around it. When we look at the current market, it's very much at an inflection point. It's not at scale yet. It's not pervasive. So what we want to explore is, what is limiting scalability and what are the solutions? So Thorben, perhaps you can kick us off there with your thoughts.
Absolutely. When we were observing the transaction that we conducted in all the different roles, registrar, arranger, market maker, and so on and so forth, custodian, we observed that we still obviously have a lot of fragmentation. Now it's becoming better. We are progressing towards standards. That's good, that's necessary. And on the other hand, it's very natural that you start in these fragmented niches, basically, because obviously the challenger product, the challenger technology hasn't existed before, so it can only be small. So, but now we need to converge towards standards. What we also observed is that all the issues that we conducted had an extra spread of roughly 10 to 20 basis points. Now that's not very nice for the issuer, and the reason for that is that we are lacking liquid secondary markets at the moment. That's one of the major issues that we are facing here. That's why we are working actively with other market participants together to create these markets, because obviously if you're an asset manager, you want to be able to sell the bond to convert it into cash again once you've bought it. Even if that's just a hypothetical possibility, you want to be able to do this. So we have to create these markets. One critical enabler will also be the central bank eligibility. We've got that now for paper issued through CSDs. We need that for all the paper issued using a DLT technology. And that's also critical because if you cannot use these bonds as collateral, that makes it really tough for the market makers and the investors to hold these bonds, and that's also limiting secondary market liquidity. So those are the limitations that we have to remove, and basically the whole market has to work together on this because this is not something that one can do alone.
Thank you, Thorben. And Sorcha, maybe you can pick up on the secondary market liquidity side of things and what you're seeing on the scalability front and solutions.
Absolutely, and I'm glad you mentioned secondary market liquidity there, so thanks for that, Thorben. But we've seen a lot of digital asset activity over the last 5, 6, 7 years, and it's laid somewhat of a foundation. But it's one thing to be able to tokenize an instrument and to settle it. It's another thing to have a functional market environment. And I think secondary market trading and secondary market liquidity is a big key factor in that, and probably the first criteria that I would call out, particularly given I'm at Tradeweb. And so building those markets, if I'm a client and I'm looking to leverage or use an asset, maybe I don't even mind whether it's tokenized or not, but if I am going to use a tokenized asset, I want to be able to trade it, I want to be able to finance it, I want to be able to use it as collateral, as well as all of the stuff that I can do with the traditional assets, so the settlement, the fair custody, and the full asset lifecycle and servicing. So secondary market is very important for building the liquid environment. If I was to think of another key factor, it would be interoperability. And in the digital asset environment, that word means many, many things. But for the sake of time, I think being able to provide networks and environments for participants engaging with these instruments to interact with one another in an efficient way, and perhaps networks like the Canton network, where that inherent interoperability is baked in, makes things easier for the institutional participants and avoids having bespoke integrations and processes for every type of digital asset that the market's engaging with. And then coming to the solutions, so we've been doing quite a lot at Tradeweb. One thing that I would call out is we have a 24/7 digital asset trading platform, which we have developed leveraging the Canton network. The first real use case and demand that we've seen, and the reason really that we developed this platform as we're so client-driven, was this interest in this intersection between traditional market players and perhaps the more digitally native players to trade 24/7 tokenized repo, different forms of digital cash. And we're looking to support, from July of this year, DTCC had announced recently that they will be tokenizing US Treasuries directly on-chain. And so the solution that we provide and that we're looking forward to contributing to those 50 or so participants from July is providing this secondary market and the ability to finance, whether it's out of market hours or intraday. And briefly, just to mention as well, within regulated regimes in Europe and the UK, because they're also really important, we're developing a different platform. In Europe, in the EU regime, there's a TSS application, and within the UK, for their digital security sandbox, similarly, there's a DSS, so lots of acronyms with S's. But really, the gist there in those regulated regimes is bringing trading and execution and settlement closer together. And so the solution there is, in addition to the secondary market, bringing those pieces of the asset lifecycle for tokenized instruments closer together.
Okay, thank you, Sorcha. So I guess we've quite explored the scalability issues from a DLT perspective. That takes us on to AI. And Danilo, earlier in your speech, you were talking about the different phases of AI from here to phase 3. If we're looking at the DCM side of things, what are the limits to scalability today, and where are the solutions?
I think one of the things to consider is that by end of this year, we should get to 200, 250 IQ when it comes to AI. When you do it properly, when you know what you're doing. And in banking, DCM is no exception. Human in the loop is quite a big concept. And I remember when I was in banking, always trying to talk to regulators, SEC or whoever it was. Human in the loop was something that we all wanted to protect. But how do you protect human in the loop when the thing that producing the work that the human is checking is far smarter than you and far more capable, far faster than you at doing that very thing? So when I mentioned super narrow AIs, there's many super narrow AI being built for the banking space as well, including DCM. So I think one little challenge we're going to cross over soon is the human in the loop challenge, when it starts to not make any more sense to have a human checking. Also, I think volumes are going up. Ticket sizes are reducing, so there's more market participants. So the volume of work, the speed of work is going to increase as well. So that's another challenge. I think, the main opportunity here is not just making things faster, doing documentation faster and preparing and giving better advice to the trading desk or whoever it may be. I think the opportunity here is to truly transform the way that your bank or if it's just a DCM department, is actually functioning. You guys should really look at the concept of workflow engines for coordinating work, coordinating humans and AI together. Because I think that's the only way you can truly transform. And once you've unlocked the intelligence, the business intelligence in your organization, you're optimized everything that you can see which is manual or could be optimized with automation or AI. You then start very quickly shifting the work towards AI, but in a very controlled and a very safe manner. A lot of us are being sold agents that can do autonomous work, but never in a million years are any of us going to allow an agent to autonomously work in the bank, right? That makes no sense. So that's the other reason why workflow engines are very important. And by the way, because you hear me say the word workflow so many times, I don't own any shares in workflow engines. I'm not partners of any of them. It's just that it was a key ingredient when transforming middle, front, and back office and bringing them closer together, allowing for the flow of data to happen more seamlessly and the whole functioning of the department. So it's just a really important concept. You cannot transform, you cannot become an agentic organization unless you have workflows. And until today, nobody has proven me wrong. So something to really focus on.
Thank you, Danilo. And Fahreen, what's your perspective from the AI side of things?
I think what was really interesting to me about what Dan said was specifically around the human in the loop, because that's what we see quite consistently. So we did build our own specialized large language model, and I think that was our step to make sure that it was really focused on financial services in that space versus having generalized models that can do anything you need, but we don't really need them to write poems or a letter to our mom, but we do need them to work specifically in the regulated space. So from the specialized large language models, what did come up was sometimes these models are a lot smarter than people working with them. But on the flip side of that, what you do have is, one, regulators who do still want the human in the loop, but two, there are individuals in the space who understand culture. And that's something that you can't really replace at the moment. So understanding the culture of the organization and being able to look at, you might have a 92% reduction in false positives, and you might be able to reduce your workflow or even just the content of your data significantly. But what you're not able to do is understand the culture yet, which is if someone has worked in that bank for enough time, they will know that actually that's just how someone speaks. And you can look at specific models with a little more context versus just lexicon-based approaches, which are very, very old at this point. And so we are looking at the context of communication, but you still aren't going to understand why someone speaks in a certain way, how they come to work, how they approach their day, how they communicate with their peers, and that will be translated, whether that's in e-coms or ACOMs, in how they communicate. And that's where you need the human in the loop to be able to flag specific issues. So on that, I think the human in the loop, at least in our space, will still be very important and will still be necessary, at least for the foreseeable future. Down the line, there might be specific tools that you can do to change that, but for now, I think we'll have to keep the humans for a bit.
Thank you, Fahreen. So that takes us on to actually a topic that Yana mentioned slightly earlier, which is programmable money, cash side of things, and that playing a role in the digitization of the DCM markets. So with that, Sorcha, I was going to ask you to begin in terms of what solutions you are seeing or predict will be kind of taking a role in the money side of things.
Sure. Well, digital money is half of the challenge and half of the transaction when we think about a tokenized trade. So if you have a tokenized instrument, but the cash is still existing on traditional rails, that DVP is still limited by whatever the same frictions are of our existing payment rails and our existing banking rails. So digital cash is very important. Now, from the trading platform perspective as Tradeweb, we're relatively agnostic as to what the best form of digital cash is or will be. Though there are different use cases and different circumstances where you see kind of front runners and winners across the different forms of digital cash. So, for example, with stablecoins, they're highly liquid. And when I referred earlier to our 24/7 trading platform and supporting these tokenized treasuries, stablecoins have been, so far, a digital cash form of choice for a lot of those market participants that do sit on the cusp between the TradFi world or the traditional finance world and the more digitally native world, potentially when they're looking to trade on a Saturday based on a tweet that has related to a political change over the weekend, they're going to be looking to settle in a stable coin.
From Trump.
Well, I didn't say that. And then if we move on to another form of digital money, tokenized deposits, those are really important and really useful when we think particularly about wholesale institutions wanting to settle in commercial bank money. And so the existing client relationships and infrastructure and pipes that they have with their bank, they already have a bank account. That bank issues a tokenized deposit and gives them access to digital money, perhaps without them even realizing it. And so tokenized deposits certainly play a role for some participants. And then I think, as Yana had mentioned earlier, in these regulated regimes and jurisdictions where central bank digital cash or ultimate settlement in central bank money is important for negating risk, we've seen excellent work come out of the ECB as it relates to their central bank digital currency efforts with Pontus, and we've also seen other central bank equivalent digital cash solutions like Finality. And so in terms of what we're seeing at Tradeweb, we see a bit of a mix and match across the board. And really our job is, and our view is, that we want to make sure we can be flexible and enable all of our digital asset solutions and trading platforms so that clients and counterparties in the market have choice.
Thank you, Sorcha. So that kind of takes us to Yana and the wholesale central bank money side of things. So what are your thoughts?
Indeed, we cannot talk about digital money in Europe without thinking about the wholesale digital euro. If you recall, initially when the digital euro project was launched back in 2021, it was purely a retail use case. And my organization, DSM, actively advocated to develop a parallel wholesale digital euro work stream since 2023. And we're very happy to see that over the last 2 years, actually, this work stream is progressing really well. And the first experimental transactions for issuing digital bonds settled in wholesale digital euro are now underway. Needless to say, this is the safest settlement asset and really a cornerstone if we want to maintain trust and financial stability in this evolving financial system.
Thank you, Yana. So we've got time, so what would be really good to hear from each of the panel is just take a minute on what your predictions will be in terms of both the DLT and AI side of things for the DCM and fixed income markets. So, Yana, do you want to begin?
My prediction is that regulation and supervision will continue to evolve. I mean, clearly in this new environment of 24-hour, borderless, potentially, financial markets, the speed and scale of risks is changing dramatically, and this calls for rethinking entirely how we manage those risks and how we supervise. So MiCAR is reopened now for public consultation. I expect to see a lot more changes coming over the next 12 months, including a move towards centralized supervision and away from a country-based one.
Thank you, Anna. Fahreen, what are your thoughts? Taking a minute.
I think the differentiation will not be who has AI anymore, but it will be who has AI they can govern. So going back to what Yana said, I think the regulators are also getting smarter, and they're going to care a lot more about how can you evidence and explain and defend your models so that they can actually also control what's happening in the markets versus just having AI run rampant in the space.
Thank you, Fahreen. And Thorben, what are your thoughts?
On AI, we think it's all about agentic AI. So there are two types of agents that we will implement. One is a coding agent, helping us with all the easy stuff that we need for the coding. The second one is the risk management, risk positioning agent. And then the question there will be in the near future, actually, do we want to have or replace, when demographics kick in, replace 10 traders, or do we rather have 8 agents, 1 AI engineer and 1 risk manager to supervise the whole thing? And on the DLT side, we'll see more standardization. We're in the most interesting phase for standardization. I believe that the creation of secondary markets is picking up pace, and I believe that the central bank eligibility for DLT issues paper will be granted.
Thank you, Thorben. And Danilo, as Mystic Dan, what's your prediction?
More predictions. Wow, you guys really want to put me on the spot. No, this trip in China was really eye-opening. I think one thing I would say is I don't see how large organizations are going to transform with AI just by using private models. The cost of tokens and the licenses are going to balloon out of control, and it's going to cause serious problems. So one myth that was busted when I was in China was this thing of Chinese open source models being unsecure. It is completely not the case. Because it is open source, it can be completely installed in private clouds. It can be completely configured, and in many cases actually has higher performance. So I think one trend that's going to happen, one prediction, is a lot of companies are going to open their eyes to this thing that they're going to need to do, which is to mix private models and open source models that they can configure. And one of the ways to win is, of course, how to govern AI, but also how to create a USP with that recipe. Because if you can have open source models that you can tweak the weights and the way you use it, that can give you a competitive edge as well. So it will help you reduce the cost. So open source models are 90 to 80% cheaper than private models. That's massive when we're talking about billions of tokens. And highly configurable and actually safer than a lot of private models. And this is a misconception in the market. So I think that's a big trend that I foresee in the next 12 months or so. That mixture, that recipe of open source versus private models.
Thank you, Dino. And Sorcha, what's your predictions?
I think I'll focus on predictions for the digital asset space, the DLT space. But really, we've seen enough proof of concepts now. It's my biggest prediction for our digital asset space is that we're moving away from the testing. We've already proved that this works. The technology works, tokenization works, the pipes work. And so now my prediction would be that we'll see a bit more trading and a bit more secondary market liquidity. Maybe I'll just do a quick run through as well for UK, Europe, US. US, I think the next 12 months, it's going to be pretty transformative, the work that I referred to earlier that DTCC is doing. And so look forward to seeing what the impact that has on tokenized 24/7 treasury financing workflows. Within the EU, I'm excited to see how the ECB continues with Pontus leading into their longer-term digital asset vision, which is Appia. And at Tradeweb, we're going to look forward as well to supporting and keeping as close to those initiatives as we can. And similarly, in the UK, in parallel to the UK Digital Security Sandbox, HMT issuing their first digital gilts in the Digit exercise. We're looking forward to seeing how that unfolds over the next 12 months too.
Thank you, Sorcha. So actually,
Can we bring something up, which was, could we keep talking about governance? I got access to see Mythos a short while ago. And one thing that I think everybody needs to be prepared for is the need for continuous authentication. So this is no longer multi-factor, you walk in, there's an authenticator. We're talking about continuous authentication, right? So constantly checking if you are the right user. If you're navigating in parts of the system that you don't normally navigate, that brings up red flags. The need, not the convenience, but the need for needing to have retina scans, fingerprint scans, so as much as the physical form as possible. You can fact check me later, but last year in the US alone, fraud through impersonalization through AI was over $4.5 billion. And it's likely to surpass $10 billion this year. So, we have a lot of these systems which are setting up. The governance side, it's really important, right? I mean, I've been in banking, I know. But I think we all need to be prepared for a very different cybersecurity world this year. And thinking ahead is going to be really crucial as well.
Thank you. So we have 4 minutes. So it's, can we ask questions?
Panel questions?
So I guess we have time for at least one question. So does anybody have a question for any of the panelists? No, everyone's left stunned. One over here? Yep.
You want to shout or what? Oh, we need the mic.
Stand up.
Hang on, we can't hear you. I'll just give you the mic.
Thank you.
But we can now see everyone. They give us a lot more time.
Mike Limes from The Banker. Could you please talk a bit more about about your trip to China, and about the point about the public versus private models, and the kind of that hybrid world you might see, and how banks specifically are going to have to navigate that, and about, I think, public models being cheaper and more secure. Am I getting that right? Because that seems to be a really big thing that you were saying that people don't get.
Yeah, sure. So the reason why I went to China was to do a tour of China. I went to meet all the CEOs of the AI companies, robotics companies, and I wanted to see where the technology is at. Unlike many of the people in AI for Google, OpenAI, etc., they're barred from going to China. I'm free to kind of do as I please, and I work with everyone. So Monday, for the podcast, I'm interviewing one of the heads of Google when I was just in China last week. So I'm free to roam, which is a privilege. And the reason why I went there is because a lot of the Fortune 100 companies I advise, they're starting to run into token cost issues. So the fact that, OpenAI, Anthropic, Gemini, they're all charging huge amounts of money for the use of agents, also on the Microsoft side. And many companies are actually not moving forward with their AI transformation because of these costs, which are enormous. So I wanted to try and help solve this problem. And the only solution to that is open source, which is free. You just pay for the compute side. So yeah, some of the things I found from China was that, some fun facts. So the US, which is the leader in frontier models, they have spent 23 more times capital than China has. Yet the models are only 2.7% better in performance. If I was an investor, I would be really unhappy. Of course, if you're dealing with healthcare or highly sensitive data or something that is a difference between life and death, that 2.7% really matters. And that's where you should use frontier models. But for a lot of things that we're using today, like OCR technology, optimizing payments, a lot of that is just optimization, right? And it's models which have been around for a very long time. Even the open source versions of OCR are as good as the paid ones. And it's a commoditized technology. So I think the trick is going to be, going forward, finding the right mix of what to use an open source model for, because it's not maybe highly sensitive data, or it doesn't have a tremendous risk attached to it. So use a model which is slightly less capable. But then for things which really matter, it can cause you a reputational risk, regulatory risk, can cause a market crash, then of course using a frontier model for that. At the moment, I noticed that China is about 6 to 9 months behind the frontier models of the US. But a couple of fun things that will happen. So the US is in a talent war. They're paying sometimes 50 to 150 million for an engineer who really knows AI really well. In China, they're paying them multiples less. Access to cheap energy. In the US, energy is certainly not cheap. In China, they are providing special rates to AI companies so they can build models faster and cheaper. So there's many more differences and nuances, but that's why I think over a period of time, the 6 to 9 months will actually crunch down to maybe a couple of months, if not exactly the same performance. So we really have to be cognizant of that. And the last thing I would say again is, this fake propaganda that Chinese open source models are stealing your data. Yes, if you use Chinese cloud services, they will steal your data because data is very valuable and they don't have a lot of access to data in the Western world. But you have to make a very clear distinction here and not be ignorant about the subject. Cloud, Chinese services, yes, they're going to take your data. Chinese AI open source models, they can fully configure and put in your own private cloud, and there is zero data leak. There is no data leak. And I think what happens is, in the news, we kind of meddle the two together, and it makes everything seem like, oh, all Chinese things are unsafe, but that's certainly not true. So I can tell you more offline, but that's kind of the summary of it.
So with that, thank you to all the panelists for their expertise and their time. And